this is going to be a weekly market update for the week of the 29th, the last week of April. I'm going to run through some data here and some key commentary points. And yeah, I'll post this in. You'll feel free to comment on the bottom. Anything you want, any questions you might have, any follow-ups, don't ever hesitate to reach out to me directly if you want to know a bit more about what I'm thinking here. Let's get into this here. So the biggest thing that happened last week was GDP came out, and overall the domestic economy grew by about 1.6% annualized in the first quarter. But this was dragged down by a couple of things, including inventories and trade. Consumer spending continued to hold up well with an annualized increase for the quarter of 2.5%, but that was still shy of expectations at 3%. Consumers did pull back on goods and purchases and focused on demand services in the economy, still recovering from the pandemic shock, which is kind of crazy to say. So look, at the end of the day, people were starting to spend less, and GDP is not growing as fast as we like. We're not in a contraction, we're not in a recession per se. We haven't had back-to-back quarters of negative GDP growth, but things are kind of stagnating a bit. And the biggest reason is because of sticky inflation. So those looking for evidence of cooling inflation in last week's GDP report also came away disappointed, as the core personal consumption expenditures, PCE price index, which excludes food and energy, rose 3.7% annualized, up from 2% in the fourth quarter. This is the Fed's preferred inflation measure. So their goal is 2%. I joke 2% is the least amount that we will notice us getting robbed by inflation. And so that's the overall goal here is 2%, and we're not there at all. We're at 3.7%, and it's actually ticking back up. Zooming in on March, though, the core PCE inflation reading was more reassuring, with annual readings holding steady at about 2.8% for the same pace as February. Friday's 1% rally was mostly on earnings. More on that below. But in line, March inflation data helped. Before we get to the Fed, a few more observations from last week's data, right? Inflation for services and goods are now two very different glide paths. Annual services inflation was 4% in March, but goods inflation was roughly flat. And we'll continue to watch the service inflation closely. So with all this market data coming in, though, markets did not respond well at all last week. Last week we had a big drop in markets as people were digesting this. Bond investors may have to wait a bit longer for a rally. Long-term treasury yields may stay above the LPO research year-end target of 3.75% to 4.25%, longer than we had previously anticipated. So the bottom line is we are getting the higher for longer. Everyone was expecting rate cuts at this point. Rates are staying elevated, and markets were really digesting that for the first time yesterday. So here's the good news, and this is actually really good news. Earnings seasons has started, so we are reporting on Q1 earnings. We are underway with that. Big earnings-driven gains in shares of Google, Microsoft, and Tesla, alongside double digits decline in Meta. So these magnificent seven have kind of mixed results here, but here's the good news. A solid 80% of S&P 500 companies that have beaten earnings estimates so far this quarter. So companies are still making money, which is excellent to see. That shows that the consumer, while changing their spending habits, are still out there in the economy. And 63% of the S&P 500 companies have beaten by more than one standard deviation, compared to the historical average of 48%. The average upside surprise for earnings is over 8%, a solid number relative to history, but in line with the 5-year average. Big technology companies that you just mentioned more than held their own. Tesla was by far the winner of earnings. We're up about 25% in about a week, going from about 144 a share. We're trading just under $200 a share right now. So this is all great news. So once again, as an advisor, I'm never trying to look in the short term, but we got a bunch of mixing signals here. We have companies that are making money, but we have inflation that's sticking around. And all this is driven now what the hell the Fed's going to do with interest rates. So it's really short term, hard to imagine what's going to happen in the coming weeks, coming months. But once again, this is why it's ever so more important to have a financial plan. And this is what I'm here to offer people. So the biggest thing is while we can always analyze the data week to week, it's really important to keep a long-term focus here and make sure your money's in the right spot so you can handle the waves, the ups and downs of everything. So welcome back. It's really exciting to do this again. I'm going to try to put this content out weekly. If you have anything you want to see specifically, please let me know. But thanks again for your time, guys, and we'll catch you next week.